Every investor wants that undervalued gem that could just boost your portfolio. It's your multi-bagger, your 10x stock. Today, we're going to talk about one of the stocks that I think could be exactly that in my portfolio. It's ARC Resources. It's a name that we've talked about a few times on the channel that has a fantastic opportunity and that hasn't seen the kind of share price growth that it has in company potential. So today we're going to talk about why I think this is so undervalued. We're going to talk about my long-term thesis behind this stock and why I think if you're willing to hold this for 5-10 years, you can make a huge amount of money. Now, as always, I should say, I'm not your personal financial advisor, so please do your own research. Check out if this fits your thesis. I have a specific investing style. Not everybody invests just like me, so it's always worth doing your own research. We've got an article on the screen right beside me that helped spur on this thought, and it talked about the idea of looking beyond 2028. Now, at first, that might seem like an arbitrary number. Why is a 3-year out time frame that important? But I think it fits the timeline we're in really well for this industry. Think about all the storylines we've got behind Canadian oil and gas. We've got this new government who's at least claiming to be in favor of the industry after 10 years of governments trying to slow them down. We have got the US shale oil decline, where producers are not able to continue production growth the way they thought they would be able to, where we've seen geology itself start to slow down American producers. And yet we also see a massive slew of LNG projects coming online between now 2028, with, of course, our name brand LNG project here in Canada, LNG Canada, coming online just last month. All these put together mean that the natural gas space specifically in North America is primed to explode. And as investors, we've been preparing for this for at least 6 months. We've been buying into these stocks, but we haven't seen the share price growth just yet. We saw some initial excitement, but we haven't seen that kind of massive return. I think that means that actually right now, this moment is one of the very best to buy into these names. Because if you look at PE ratios right now, they are brutally low. ARC is trading at a single digit forward PE on a company that expects to at least double their production. And that's not even to mention the fact that industry experts expect natural gas prices to double in the Canadian export market. All in all, we could be looking at an ARC Resources making more than 4 times their current revenue, and you're buying it for a PE of less than 10. Let's go through what this author has to say, why he specifically thinks that this is such an undervalued stock that you should be looking at. Then we're going to talk about some of the wild cards that I think might add some very fast value to this stock in the next 2 or 3 years. So a couple key points the author has here. He talks about quiet compounding value through their production growth, margin expansion from LNG linked pricing, and a shift towards more liquids. They talk about their cacao acquisition, how it strengthens their asset base. Their corporate netbacks, maintenance capex are set to rise sharply as more gas flows into premium. So basically they can afford to expand more and grow more. My base case that strip pricing projects 14% compounded through 2030, which is quite an impressive return, with aggregate buybacks reducing the share count towards pre-2021 levels. So not only are you getting a great return, but also you are getting a bigger piece of the pie, and that ARC is his biggest oil and gas pick, thanks in large part to what's on this image, LNG. So ARC Resources is, in my opinion, building the most attractive long-term cash cow in North America's oil and gas space. Big note here, this author talks about all of North America. We're pretty Canadian focused on the channel, but this author actually loves this beyond just the Canadian border. Most investors focus on the current dividend yield, which is true. And at ARC, you see only about 2.8 dividend yield with a PE of about 10. It's actually under 10 right now on a forward basis. But they are a silent compounder. Magic happens when you add several factors together. Production growth, we talked about. Improved margin, we talked about. Improved production mix, which is really interesting, and higher expected Canadian gas prices. Management is guiding over $4 of free cash flow per share in 2028, which is a 15% yield, which is already a decent reason to invest, 100%. And he's going to take you beyond that, where the majority of their energy contracts come into play, so you better understand why they're positioned to outperform. He's talked about ARC a couple of times. This isn't the first time we've heard from this author. And specifically, we talked about the cacao acquisition from Strathcona Resources when Strathcona did that big shakeup of the Canadian oil and gas space in their attempt to buy MEG. Now, we haven't seen how that finished out, but ARC got basically a steal deal on great assets that fit into their existing portfolio really well. We'll talk about this a little bit more later, but I just love seeing in the Canadian space a lot of companies really making smart choices, If you look at the mix of assets ARK owned 10 years ago, and you look at what they own in 2024, 25, it's clear they have focused on what works. And I think this is a huge benefit when those Duvernay and Montney assets are becoming so valuable for external money. Specifically, I'm thinking American shale oil producers who are starting to run low in the Permian, who are looking for somewhere to expand to. Makes a lot of sense for that money to come into Canada. I think it's really, really interesting. In this author's opinion, he doesn't think ARK overpaid. I think that's awesome. We don't want to see ARK overpaying. He likes that it improves their liquids profile, makes a lot of sense, and that their balance sheet's in perfect position. Their expansion, their margin expansion is expected to be huge. If we look at this, it's kind of a complicated chart, but basically if you look at how things go, we see 2024 actual, and then everything after that has an E for estimates. And you look at where sort of the revenue, the netback, corporate netback goes. So we're seeing that ARK is just absolutely going through the moon, right? We see all the way up to that $4. That's an awesome spot to be at. And that's at WTI prices of $70. I also think that there is potential. Now, don't, take this as gospel. Trying to predict commodity prices is brutal. But I think there's potential for us to see actually a higher WTI price over the not so distant future when we continue to see growth in oil demand from places that are currently burning coal in the global south, which is basically all the countries that are still working on developing their economies and industrializing. And we've seen a lot of them in the current political climate start to push towards more natural gas specifically, but also oil versus trying to jump from coal to green energy. I think it's a story that a lot of people don't love to admit because it does sort of combat a lot of our beliefs here in the West that we can just move towards green energy. But if you are invested in this space, it is definitely a potential benefit for you. And I think it's really interesting that we see how much the money they're spending on capital expenditures, which is that little dark circle right in the middle. You see that they're expanding capital expenditures dramatically. Now, sometimes people worry about that. I should say this, that often dividend investors are looking for a company that can consistently grow the dividend, 100%. We love that. That can stay stable and is going to pay out in the long term. And sometimes CapEx growth can be bad. But I think in this case, it's actually really beneficial for investors because not only are they looking to expand CapEx, but they're also looking to expand CapEx into a much easier growth market. It's a big part of what we talked about at the beginning with the political shift. We've talked about this since March, essentially, when suddenly we saw a lot more of the Canadian population sort of become more friendly towards oil and gas production, but also oil and gas production and export growth. We've seen the whole idea of these nation building projects that we're hoping to see actually come into fruition, or at least get more talked about this fall when the government sort of comes back from their summer break. But still, I think there's an interesting story there where they're going to be able to produce more and then also sell it at a higher price. And they're not going to be so constrained by the current environment in the oil and gas space. I think investors are at least cautiously optimistic. A lot of the ones that I've spoken to about this that are sort of, in this space, that talk to people, that know people, are saying that across the board, the word is cautious optimism, and that people are looking positively at the industry, at industry growth, as long as we see something get done, let's say in the third, fourth quarter of 2025. If you start pushing beyond that, I think you're going to start seeing more and more pessimism about production growth, and you might see some companies reduce their expected CapEx spend. But still, I think ARK putting themselves in a position to grow is smart. Makes a lot of sense right now. Of course, one of the most interesting things that these authors on Seeking Alpha often do for us is they build in interesting projections. And we'll go through the base case, which I think is really interesting. But we're also going to talk about the bull and the bear case, because as always, we want to see what the risks are. And one of the first times I talked about ARK, I actually mentioned their asymmetric upside, because basically they are a fundamental producer of the resources needed to produce oil in the first place. And so as long as these big oil sands players just keep producing oil, which they can do for literally decades, ARK is more or less good. Their downside is protected. But the upside was super interesting on ARK because they had this potential to grow and grow and grow. So we'll see exactly where the current situation stands as we've gone now into the sort of second, third quarter of 2025. He has some assumed strip prices that are pretty low. WTI at $62, ACO at $3, Henry Hub at $3.5, LNG up at $12. He thinks is the lower end of the mid-cycle price range. I would say specifically the WTI I think is on the lower end. Love seeing that AECO going up to $3. I think that will be game changing for a company like this. And he talks about CapEx and all the spend. And as you look at how things go, right, we see the kind of growth numbers, the growth percentages, right, in the free funds flow. We continue to see that dividend just growing and growing and growing. It's going to be about 5% by 2030, which is great. That's great dividend growth. We see great production growth. As you look across the board, right, he's keeping the production stable. He's keeping the prices stable. And as they grow through the plans they have right now, we see a lot of awesome growth. We also see a reduction of share count down to 483 million shares, which would reach the 2021 pre-acquisition levels, which is awesome. Corporate production is guiding for 450, but that was calculated with higher oil and gas prices. So if you do see oil and gas prices continue to rise in the next year, compared to where they were, let's say April, May of this year, then maybe you do actually see the share count drop all the way to 450, which again would make a per share number look even better as ARK continues to grow their production. Bull and bear case. So if we look at some different commodity prices, this is a slightly more bullish case, right? We see WTI is sitting up there at $70. Henry Hub is at $3 up to $4 by 2030. AECO is up to $3.50. LNG is again about $12, but you can see there's even more growth here. You see up to a 30% free funds flow by 2030, which would be great. Shares get all the way down to 336 million. So that would be fantastic. Slightly more bullish, you see $80. So that could be almost a 50% free funds flow. Insane numbers there. The dividend again is growing nice and stable, but just great growth. Shares down below the 300 level. And so you see this is I think this is their bearish case, right? You see $50 oil, brutal. I think honestly, anytime I read about a $50 oil bear case, I start to think like at this point, I would assume that somebody is going to be more desperate for the resources that ARK has and is just going to pay you a huge premium to get out right away. But even in this case, right, their dividend is covered. They continue to grow. Share count doesn't drop meaningfully, but it doesn't not drop at all. And this is that, again, $50 oil, $3 Henry Hub, $2 AECO. Like, I don't see this happening, to be honest with you, be completely honest. So basically, the bull case is a fantastic growth of the company, huge free funds flow, and the potential to massively accelerate dividend growth while still giving you a much, much better per share EPS, a much better per share performance, let's say, because they're going to cut down on the share count. It's also at the same time as they're able to ramp production growth, they're in a position to continually grow their CapEx. Just to show you why a company where the downside is essentially you collect a dividend that is slowly growing and the upside is literally a 10x is so interesting to me. I'm going to show you a little bit about where this company stands compared to some of its peers that don't quite have the same potential. On the screen right here, I have got basically this is from FinChat. It's a forward PE and a current PE ratio of ARK compared to a whole bunch of other producers, some large, some small. Got everyone on there from Whitecap, C&Q to Imperial, Cenovus, Tourmaline. So all these companies in the very same space. Look at the forward PE numbers. You're going to notice something right away. The ARK is the only one on the list right now that is trading at a single digit forward PE. On top of that, their current PE is only beaten by Whitecap. Only Whitecap beats their current PE. So this is just about the most undervalued Canadian oil and gas play. It has the same, if not better, potential as just about every name on here. You can argue that C&Q has a longer term potential. Sure. You can argue that maybe the refinery assets of a Suncor or an Imperial give you more stability, and so they deserve a higher premium. But still, you are paying somewhere in the range of 5 to 8x in PE to buy a Suncor or an Imperial. You are even paying up 5x PE to buy a Whitecap right now, which is, again, a great company that we love on the channel, that we think is going to grow fantastically. But ARK is just cheaper. It simply is cheaper. If I look at some of the historical growth numbers here that we can see on the screen, again, we're looking at FinChat numbers. If you look at let's not look at the 5-year, because again, we're going to be super skewed by 2020, but look at the 10-year revenue growth, 15%, right? We saw that they're expected to continue that kind of growth through the next 5 years. If you look at their EPS growth over the last 10 years, we're at 19%. Again, they're expected to dramatically reduce share count. So you can see that accelerated even more. If you look at the dividends currently, we saw how huge their free cash flow could be. We saw that we could be seeing a 50% free cash flow yield in 2030 based on a bull case. If we look at currently where their dividend sits, what the payout ratio looks like, it is incredibly well covered, and they are dramatically increasing free cash flow yield. So the dividend could not only grow at its current 3-year growth rate of 24%, but we could be seeing a growth rate of 20, let's say conservatively 20% year on year on year on year on year. A 5% dividend could be a joke for ARK investors in 5 years based on the current projections. So what do I see happening with this company, and why am I so interested in it? Why is it that beyond this 2030 range, you could see even better returns? Well, I think the story really is resource scarcity and the importance of owning high quality shale assets in North America that are not running dry. Because even in the worst case scenario for ARK, they are sitting on fantastic resources that are expected to make them an insane amount of money. They are in a position where if nothing changes, if you see prices sit at a stable, relatively normal rate, if we see none of the potential growth of this industry, they're simply going to be able to return you a fantastic dividend. They're going to buy back shares constantly, increase your stake in the company. You could be looking at a very clean growth rate of 15-20% every year for 5 years. Get paid a great dividend and just sit on your hands. You don't even have to stress about this company because, again, the bear case is you collect the dividend anyways. Or we could see production growth. We could see a huge ramp up. We could see this company 5-10x. We could be talking about a 50% compound growth over the next 5 years. Because all of a sudden, there are more LNG projects being brought online. All of a sudden, there are much higher premiums being put on North American LNG because we've built all these data centers and we ran out of the Permian resources that we needed to fuel them. All of a sudden, we could see that the massive expansion in this liquefied natural gas market encourages more nations around the world to use natural gas as their transition fuel or as their permanent solution for stable fuel and energy. And we could see the LNG market continue to expand with markets beyond just Asia, into Africa, into South America, into all over the world. We could see a continued growth of LNG demand as we can see continued geopolitical tension around the world. We could see an increased importance on North American energy security. There are a million stories that could play out that benefit ARK. And the downside, again, is that nothing happens. And think about it this way. You were sitting on a company like this. You're collecting your 3, 4, 5% dividend. Let's say that it grows only at the 5-year compound growth of a 9% dividend growth rate, which again is great. And you're sitting there on your hands, you're thinking, oh man, I missed out on other faster growing names. Well, what do you think is going to happen for a company if you see a PE ratio so low, if you see a price to earnings growth that is at 0.2? There is no premium being put on this name at all. Well, someone's going to buy it. That's what happens every time in this Canadian industry. We see a smaller cap player that has a fantastic asset base that can produce a huge amount of free cash flow, and the stock's not going anywhere. Somebody steps in, and you could see an instant 30-40% boost. And that way, your opportunity cost is limited because seriously, there is no downside here. Anyways, these are my thoughts on ARK Resources. It's why I think it is such an interesting stock play. It's why I think that it's a really interesting space to be in. If you want to see why I'm so interested in smaller cap Canadian names, why I'm looking for these undervalued plays, check out our more recent video where I talk about the potential in Canadian small caps. I'll link that in the description below. And as always, I hope I see you in the next one.